This is you. You are Rajaratnam, and it is the morning of October 16, 2009. You are standing in the entrance of your Manhattan apartment at 1020 Fifth Avenue when the FBI agents arrive. There are several of them. They have a warrant. You are 52 years old, you are worth more than $1 billion, and you built a hedge fund that, at its peak, managed $7 billion in assets. And right now, in the early morning light, none of it means anything at all. To understand how you got to this door, you have to go back to the beginning. You grew up in Colombo, Sri Lanka, studied engineering at the University of Sussex, then put yourself through Wharton and graduated in 1983. You are not someone who inherited wealth or connections. You earned your way into Chase Manhattan as a lending officer, then to Needham & Company as a tech analyst, and by 1991, you were running the whole firm as president at age 34. In 1997, you took a fund you had built for Needham's clients, bought it outright, and renamed it Galleon Group after the ships the Spanish used to haul treasure across the Atlantic. You thought the name was fitting, and for a while it was. Galleon grows fast. By the mid-2000s, you are managing billions of dollars, generating returns that make other hedge fund managers take note. You have real analysts doing real research, hundreds of contacts across the technology and healthcare sectors. You know the chip cycle better than most people inside the chip companies. You understand what a gross margin shift at a semiconductor manufacturer means for everyone downstream. You are genuinely good at this, but you also understand something else. That the people who win consistently in this business are not just the ones who work hardest, they are the ones who know things first. And so, alongside the legitimate research, you build something else, a network, quietly, over years. People inside companies who owe you favors, or want to be liked by you, or want a piece of the returns you keep generating. It starts small and it grows. And because it grows slowly, and because most of it never touches a written record, you start to feel like it is simply how business is done at this level. By 2008, the financial crisis is gutting the market. Nervous investors are pulling money out of everything. Your fund is not immune. The Galleon Diversified Fund is down. Redemption requests are coming in. You are feeling pressure you have not felt in years. And then the phone rings. Rajat Gupta is someone you have known for a long time. He is the former global managing director of McKinsey & Company, one of the most respected names in the history of corporate consulting. He sits on the board of Goldman Sachs. He also sits on the board of Procter & Gamble. He is a co-investor with you in several funds. He is someone you have dinner with, vacation near, or to call a close friend. Since 2006, you have had a relationship that moves easily between personal and professional. He has invested his own money in Galleon funds. You have loaned him money to increase his investment. The line between friendship and business has essentially disappeared. On September the 23rd, 2008, the Goldman Sachs board convenes a special call to vote on something that is about to change the narrative of the entire financial crisis. Warren Buffett's Berkshire Hathaway is prepared to inject $5 billion into Goldman Sachs in the form of preferred shares at a 10% dividend, with warrants to purchase another $5 billion in common stock. This is the vote that tells the market Goldman is not failing. This is the information that will move Goldman's share price the moment it becomes public. The board call ends. 23 seconds later, your phone rings. It is Gupta. You do not need a transcript to understand what is exchanged. What happens next tells the story by itself. Within minutes of that call, you place a buy order for Goldman Sachs shares. By market close at 4 p.m., your Galleon funds have purchased 175,000 Goldman shares. The next morning, Berkshire's investment is announced publicly. Goldman opens sharply higher. You sell. The profit on that single trade comes to more than $1 million. But that is not the only tip. It is not even the most valuable one. Over the course of 2008, Gupta reaches you after multiple Goldman board calls. In June 2008, after Goldman CEO Lloyd Blankfein tells board members the firm's second quarter earnings are significantly better than analyst estimates. A flurry of calls passes between Gupta and your phone that evening. The next morning, minutes after markets open, you begin buying Goldman securities, including out-of-the-money Goldman call options, but which are worth nothing unless the stock rises substantially. Then comes October the 23rd, 2008. Goldman's board convenes again, this time with bad news. Goldman is going to report a loss for the fourth quarter, the first time in its history as a public company. The board call ends. Gupta calls your phone seconds later. The following morning, you begin selling Goldman holdings, more than 150,000 shares, clearing your position before the news breaks. You avoid millions in losses. A few weeks later, the recording surfaces in which you are heard telling a colleague, "I heard yesterday from somebody who's on the board of Goldman Sachs that they are going to lose $2 per share. The quarter's pretty bad." You said that out loud on a phone call. You said it because you had been doing this for years and nothing had happened. You had traded on inside information from sources at Intel, AMD, Akamai Technologies, Google, Hilton, and Clearwire. G-Worth, you had a trader named Daniel Chiesi passing you tips from her own sources. You had Anil Kumar, a senior McKinsey partner and close friend of Gupta, feeding you corporate intelligence for cash payments that were routed through an account in Switzerland in his housekeeper's name. The network was large enough and old enough that it had started to feel like infrastructure. What none of you knew was that the FBI had been listening to your phone since March 2008. The wire authorization had been signed by a federal judge in the Southern District of New York. This was the first time wiretaps had ever been used to prosecute insider trading in the United States. The techniques that worked on organized crime were now being pointed directly at hedge funds. By the time you are arrested in October 2009, prosecutors have recordings of dozens of conversations. 25 other people are swept into the case alongside you. 21 of them plead guilty before trial. You do not. Your defense team argues that Galleon was built on legitimate research, on shoe leather analysis of companies, on thousands of hours of reading filings and talking to industry contacts and developing a mosaic view of markets. Your lead attorney, John Dow, tells the jury that the government is trying to criminalize normal Wall Street information gathering. He presents 51 news articles and 6 analyst reports that speculated about the AMD merger, that prosecutors claim you traded on inside information. The jury deliberates. On May 11, 2011, they return a verdict of guilty on all 14 counts. 9 counts of securities fraud, 5 counts of conspiracy. The government's total calculation of your illegal gains and losses avoided across the entire scheme comes to more than $63 million. With the Goldman trades and the broader network, the figure prosecutors use publicly reaches over $70 million. On October the 13th, 2011, U.S. District Judge Richard Holwell sentences you to 11 years in federal prison, the longest sentence ever handed down for insider trading in American history. You are ordered to pay a $10 million fine and forfeit $53.8 million in profits. The SEC files its own civil actions separately and wins a judgment of $92.8 million, the largest individual penalty in an SEC insider trading case at that point. Galleon Group has already closed. The day of your arrest, redemptions began and the fund wound down. $7 billion in assets. Hundreds of employees, gone in weeks. Rajat Gupta goes to trial separately in 2012. He is convicted on 3 counts of securities fraud and 1 count of conspiracy. A judge, Jed Rakoff, sentences him to 2 years. The man who sat on the boards of Goldman Sachs and Procter & Gamble, who ran McKinsey for 9 years, who advised the Bill and Melinda Gates Foundation, serves his sentence and is released in January 2016. You served 7.5 years before being released in 2019 on compassionate grounds due to health issues. You write a memoir titled Uneven Justice, arguing that you were selectively prosecuted and that the government's case was built on the testimony of cooperating witnesses who lied to reduce their own sentences. The question prosecutors and financial regulators keep returning to is not whether the individual trades were profitable. The trades clearly were. The question is what the network itself caused the market. Every person who sold Goldman shares to your fund on September the 23rd, 2008, without knowing what you knew, lost money they would not have lost if the information had been public. The market does not function if the people with access to board calls can move first and everyone else absorbs the difference. You understood that. You built a career on understanding how markets worked. The network was not an accident or a one-time lapse in judgment. It was a system maintained over years, connecting a hedge fund manager in Manhattan to boardrooms at Goldman Sachs, Intel, AMD, and Procter & Gamble. The FBI just happened to find it before you decided to stop. If you want to see how the same era looked from the other side of the law, the story of the SEC analyst who helped bring this network down is next. And if this case caught your attention, subscribe because there is more coming.